viewers, welcome to Be Wise, Money Wise. So, firstly, Srini, thank you so much for being on Be Wise, Money Wise. I'm feeling super excited today to have you on my channel.
Thanks for having me here on your show. Thanks, Divya.
So, to all my subscribers, I just want to brief about Srini. So, Srini is a co-founder at Hyperthought Software and Design Thinking. He's a technology expert, and besides he being a successful leader, he has been a finance enthusiast, and he has a plenty of knowledge on mutual fund investment in Indian market. So, today in our episode, he is going to unleash the mutual funds awareness he has gained over the years and share his financial wisdom. Welcome, Srini.
Thanks, Divya. First of all, hi, viewers. And I really appreciate Divya for this initiative of Be Wise and Money Wise because the kind of videos that you're producing is really, really valuable for those people who are getting started, and they can gain a lot of wisdom. And I see that you're actually covering those complex financial topics in a storytelling manner. That's really amazing. Thank you so much for this work you are doing for the viewers. I
Thank you.
appreciate that.
Thank you so
And
much.
good. So, well, so first of all, I wanted to admit that I'm not a certified financial planner or anybody. I'm just like you guys, actually. I just got it 2 decades ago, and I had my own ups and downs in the financial investing, and I learned some lessons in a hard way. So probably I will share my experiences so that you could actually learn one or two from those. Thanks.
Perfect. See, that is what even we also are expecting from you, because it is always a good thought that if we are able to grasp and learn from others' mistakes, it's always a good thing, so that we can actually become better investors, right, Srini?
Absolutely. I completely agree. To become a successful investor, one should have a beginner's mind with a learning attitude. The more you learn, you become a better investor. No doubt about it. And also, you during this process, you will end up making small mistakes, just like anything else, and you quickly learn and move on, and don't repeat those mistakes again. So that's the reason I always suggest people to educate themselves, so that you don't have to make a similar mistake somebody has done previously, right? You can always learn from their experiences. So that's the best part of the books.
Perfect, perfect. So, Srini, I have some questions for you today. So, let me know your insights and thought process, and what exactly is your suggestion on the questions which I shoot to you. So, we can get started.
Hmm. Sure.
So,
Please go ahead.
yeah. So my question is like, basically, I am someone who is new to investment, and I see that
Hmm.
I have a choice overload. Like I have a choice of sectoral funds, index funds, large cap, mid cap, multi cap. Okay, so for someone who like exactly who is similar to me, who is totally new to investment with mutual fund investment, like how do I go about selection in my portfolio? Like what exactly I have to pick so that I don't end up in landing in wrong schemes or something which is not apt for me. Like how do I go about the choice overload part?
That's a great question, Divya, because right now we are all suffering from information overload, isn't it? You have too many choice, and sometimes too many choice can be a hindrance, and it can be distracting. Especially in the finance world, people are coming up with n number of products day in, day out. And that is so true for mutual funds, because if a person who is embarking on this financial journey, and he wanted to, or he or she wanted to choose a particular mutual fund, it's so much of overwhelming. I mean, even within a fund house, there are so many funds out there. So which one to choose? How do I go about it? So my suggestion for those people who are actually like who are like software engineers, and they learn some uh, good wisdom of saving the money by watching your videos and all. And it's not just save money, you also need to invest the money, because the inflation part of it. So you just don't want to just save within your savings bank account and let it you see, the end of the day, you want your hard-earned money to work day and night for you. That's the whole concept of finance, right? So you make sure that your money work harder for you while you're asleep, even while you're sleeping, right? That's the simple logic behind the financial investing. So this particular choice overload, I would say, don't worry about those too many funds. Okay. uh, I would always suggest to go with balanced funds. Okay. The person who is really starting their journey, um, I would say, just stick to a good balanced fund from a reputed fund house like HDFC or ICICI, or there are so many good fund houses out there. You can always pick any one of those good performing balanced funds. Again, good performing means, again, there is a caution here. Uh, your your past performance may not guarantee the future performance, right? So I would say just do a little bit of research on fund managers. So it is something like, are you going to bet on a horse or a the person who is riding it? What do you call that guy? Like jockey or whatever, right? Right, jockey. And then so if actually that the person who is running that particular fund has a philosophy of containing or minimizing the loss when the market is in bear mode or in the bear markets, and maximizing the returns in the bull market, then that's a good choice. And I like I mean, I don't have any associations with this fund, but I have some investments there, like HDFC balanced fund for that matter. Okay. Mr. Prashant Jain handles it, manages it. He does it pretty well, actually. So you may ask me why I suggest balanced funds. So uh, what happens in any sort of investment is, as number one important factor that determines this outcome is asset allocation.
Okay.
So in balanced funds, the asset allocation is taken care for you, because fund manager cannot exceed your equity allocation more than 70%.
Okay. So
Okay. And the debt
okay.
he can go up to 70%. He can go up to 70% in
Okay.
a. So if you are investing 100 rupees, 70 rupees of your 100 rupees will be invested in equity, and the 30 rupees will be invested in debt.
Okay.
Okay. And like you see, nowadays the market is going up and up, right?
Right.
And you reach the point where your 70 rupees become 80 rupees, and then this debt is 20 rupees still, because your equity is doing very well, right, in comparison to the debt market. So what happens is this proportion of this equity versus debt has changed from 70 to 30 to 80 to 20.
Okay.
So in order to maintain that proportion,
Mhm.
fund manager has to rebalance the portfolio and then make sure that equity portion is well within 70%. So your asset allocation is always taken care. You don't have to really pull out the money and reinvest it. All those things are gone. That is actually handled automatically by your fund manager. That's the beauty of it. That's the beauty of balanced funds. Okay, so that's the reason I always say, um,
With
when you
balance.
are starting out, go ahead go ahead with balanced funds. If you are a little adventurous, go ahead with the multi-cap fund. I would say multi-cap fund is where they invest in small cap, mid cap, and large cap as well, and they balance it. So that way you are invested across the spectrum, so that you are not going to lose out on anything. But for investors, I would say, I mean, uh, new investors, I would caution that avoid the sectorial funds, even if you have, I don't know, because sectorial funds is when you have a very good basic understanding of cyclical nature of the investments, like economic cycles. It takes cycles, and you really need to understand that. Otherwise, sectorial funds can give you spectacular results, but at the same time, when they fall, they also fall spectacularly. So I would say you should avoid sectorial funds when you are starting out.
Right. That makes a lot of sense,
Oh,
Srini. Yeah, right.
right,
So,
right. And yeah, so also keep an eye on yeah, yeah, go ahead, Divya.
so for a new investor who really want to get started with mutual fund investments, like they can give it a shot with balanced funds.
Yeah, balanced funds is the best one, because when you wanted a managed part of it. Otherwise, if you want really do not want to worry about the balanced returns and everything, then index funds are the best ones. Index funds is like they are like it represents the indices basically, and it doesn't require a lot of fund managers involvement. What happens during that process is that your returns are directly proportionate to market returns,
Okay.
and the expense ratio or the fund management expenses are very, very low.
Okay.
So I am also a big fan of index funds. So over a long period, index fund is going to give you better returns than highly intelligently managed funds. So index funds are really, really great. But it is a boring process, believe it or not, because you won't see uh, those peaks and downs, right? So all of a sudden, you feel like it's a boring process. Investment sometimes has to be really boring, in my opinion. The reason being, it's a counterintuitive thing, because people think that oh, they get too much excited, and they check their investments too often, like how much I got today, how much I got today, and okay, market is going down. Let me pull out my money, and then they get scared. So uh, that part of what I call too much of attention towards your portfolio is not advisable,
Right.
because your human emotions can actually can hamper your returns.
Right. So this kind of a microscopic monitoring is not really good when it comes to mutual fund investments.
Absolutely, I agree, because you make it autopilot. When I say autopilot, whatever the amount of money that you are saving, make sure that it is get into your target fund via SIP route. There are variations of SIP, value-based SIP and all, but I will say SIP, so that you don't have to really worry about whether I should invest or not. It should go automatically.
Okay.
Okay, that is one thing. Second thing is that when you are actually going for a SIP route, and when you are starting afresh, you are going for a longer horizons, right? Not like you invest for an year, and then you wanted to pull out that money. I don't think that is a good idea. So investment is for a longer period. So, and also you should only embark on equity when you have longer periods of planning.
Because
Otherwise, you should never indulge in exactly. Equity is volatile in nature, and also sometimes avoid that herd mentality. Like when market is going up, people think, oh, let's invest now, and you enter into you enter into the time when you get fewer fund units, because your NAV is already high,
right.
and all of a sudden, when the market is going down, you actually pull out the money. That's not so that's the reason I say avoid that herd mentality. Don't watch too much of Economic Times and moneycontrol.com. If you are a regular watch, I'm not trying to say that you should not watch those. If you are watching it minute to minute, then it is going to make you tense unnecessarily.
Srini, on this context, I want to understand what you think about direct and indirect investment. I mean, like for a beginner, should they seek help from financial advisor, or should they put their brains and then research and then, or maybe see news channels, CNBC or stuff, and then they should actually start experimenting on their own? Like, which is a better way according to you?
Okay, your question has two parts. One is which one is better, direct or indirect?
Right.
And what is the role of a financial advisory versus doing on your own?
Right.
Okay, so first let me address that first question of direct versus indirect. Yes, it's a very controversial topic because what happens, I hope you understand what is direct and indirect indirect way of investing into the funds. What happens when you actually the fund houses, you are actually investing through some third party, right? Or even for that matter, even if you are investing in a HDFC mutual fund from your HDFC bank account, still it is considered as indirect unless you actually log into their fund house web login and then invest it. So there is a little bit of variation in direct versus indirect. Direct way of investing, the expense ratio or the fund management charges are a little less, and indirect it is a little more. So that way, if you are having a 20 years of investment time span, and if you are going with indirect thing, then the outcome of your total investment can be a little different. Okay. But if you actually take financial advisor's role, what he will actually, he or she will bring a discipline to your life. Okay. They will have a structured approach, and they will understand, like, okay, what is your expectation out of this, or what is your goal of this investment. So they can actually plan well, and that can save you a lot of time and effort down the line. That
Okay.
is one benefit. I'm not I don't have any association with any financial advisor here, but I'm just trying to say that when you are starting out, if you have a very good financial advisor, that can actually save you a lot of time and effort. And also they will understand your overall goals, like you can actually invest for your retirement. So the philosophy of retirement investment is entirely different from philosophy of funding your car or a dream house down the line within 5 years. Okay, because 5 years horizon is different from 20 years, right? So you know that you're not to withdraw the money for the next 20 years. That is a very different way of investing philosophy, versus when you need that money within 5 years, right? So that is the reason I always suggest people to educate themselves, always educate themselves, and read books and read blogs. Great blogs are there, nowadays. If you really want to understand how the mutual fund works, what is the difference between direct and indirect, you just go to YouTube and you watch. Like, your channel is the best one, I believe. So they can actually subscribe to your channel, and they can keep getting these kind of nitty-gritties of investing and saving, etc. So I would say, yeah, keep educating yourself, and your financial awareness is directly proportionate to your financial independence, right? uh, See, down the line, you want to pursue your dreams without having to work for someone, right? Nothing wrong in working for someone, but it should be an optional thing rather than a compulsion.
Makes sense. There should never be some kind of pressure sitting on our head that is bothering us. Like we'll have to have that kind of a free mind, and that financial independence comes only when we take right financial decisions.
Right. And your generation, I think, basically they are very fond of the flashy things, and everything is available at the click of a button, because everything is highly, they made it very, the system is built in such a way that getting into a loan or swiping the credit card is so easy. And if you go by your feelings and emotions, you will end up getting into a, you'll be trapped into the uh, that debt trap, basically.
Mhm.
And it's you might think that, okay, I got this flashy object today, let's see it, because after 12 months I'll do this EMI stuff, right? I mean, like the latest iPhone, or I'm not against iPhone. I love Apple products, by the way. But but what I am trying to say is, like, yeah, you actually invest rather, and whatever the returns that you got, you can actually take it and you can enjoy it. Okay, so this is a kind of a habit that you need to really inculcate. I'm not trying to say that there are certain things you enjoy, you should enjoy those without having any regrets. But buying every flashy object, or just because that there is a big billion sale is there, you end up buying the things that you don't need. And there is a saying from Warren Buffett, right? If you keep on
By
buying the things that you need,
right now, you will
then
end.
you, at one day, you end up selling the things that you need. Okay, so that's a very 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 profound quote from him, because uh, if people pay attention to that saying, they wouldn't buy all the unnecessary stuff on the market. Yeah.
Right. So, Srini, I have a question, another question for you. So, the thing is,
Uh-huh.
during these turbulent times, like the global pandemic, COVID times, like investors who have already been into doing SIPs, who have already put their lump sum amounts into various mutual fund schemes. So basically, they are into a dilemma situation, like if they should continue their investments or pause their SIPs, or how do they do it? Like, what? Pull out their money and invest at a later point of time when market corrections happen. So they are into a lot of dilemma situation. Like, what do you think is an ideal situation right now that is beneficial, or should they really continue with their SIPs or pause it, or what is it? I mean, like, what do you think about this situation?
Right. That's really a great question, and everybody encounters this question, because um, they always think that, oh, I want to get the maximum return out of my investments. How do I do that? Right. So if you are actually investing for a specific goal, for example, say for example that specific goal has a time limit, or a duration of 10 years, for example, you should never actually stop your SIP when the market is going in the bear mode, right? I'll tell you a simple logic. Because if you are actually having 10 rupees is your NAV,
Hmm.
and your NAV became, because of this 46k, recently it touched 46k, I think, market. And because of that, your NAV got up to 15 rupees. Okay, so for you will end up getting, for every SIP, monthly SIP thing, you will end up getting lesser number of units, because the NAV went up.
Hmm, correct.
Okay, so and all of a sudden, God forbid, I don't know what is going to happen next week, but if it actually market corrected 20%, for example.
Okay.
Okay, 20%, which
Hmm.
is around 9,000 points, right? Close to 9,000 points, but then it can go to 36k, right? 36,000 points. Then all of a sudden, your NAV that was 15 rupees
Okay.
will be around 8 rupees or 7 rupees.
Right.
Then what happens is, if you don't stop your SIP,
Okay.
then you will end up getting more number of units.
Okay.
in the next month, say for example in January, you will have more number of units accumulated. Okay, since you already finalized that your fund is good, your fund is balanced, and it is having a good track record, fund manager has a good track record, you really don't need to worry about it, because um, fund manager is anyway going to make sure that you are not going to get into the severe loss. Okay, so he will do his own thing. You are paying some money to him because he is managing your own funds. That's why you are managing fund management expenses, right? That expense ratio and everything. And that way you are protected. But say for example, in case if the NAV goes down, and then what in the January, say for example, this market went down and you stopped SIP. Okay, so you only accumulated those units at a higher price, so you will not be getting more number of units. You missed out that chance. So when you have the SIP done on a monthly manner, you should never stop it, in my opinion.
So basically,
And second thing is that if you have a lump sum, yeah, well, I think that's another topic for the day. Timing market and the intelligent way of investing. So uh, Mr. Market, they call it, right? Mr. Market is very, very intelligent, and time and time again, he will prove all the pundits wrong. Okay, whatever the speculations you might do, it is none of the speculations actually come true, and you can't time the market, because just because of the fact that um, the markets are driven by human emotions. You know that, right? Markets are driven by human emotions, not exactly by the actual value of the underlying assets. So people think that, okay, vaccine is on the way, so all of a sudden they respond exaggeratedly positive way, and then people that will push the markets up to maybe 50K, you never know actually down the line, and all of a sudden that is blown. I mean, it is a kind of a made up thing, and actual reality kicks in, and then market crashes. So this going up and down are quite it's the nature of the market. But that those fluctuations are going to actually work towards your advantage when you keep doing that SIP, not coming out of the SIP. So definitely SIP should never discontinue.
okay.
That is my opinion, and they should keep doing. So the it is not about timing the market. It is about your time in the market. It is not about the timing the market. It is about your time in the market. So how much long duration you are in the market is going to determine your success. So say for example, you say, okay, I am going to wait on the sidelines so that market is going to crash, then I will invest. Then what happens if it keeps on going up and up and up, right? 50K, 55K, then you already missed out.
Right.
Instead of that, you actually start investing in the market. You surf that wave, and then when that crashes, that's fine. I mean, you're not going to lose that money. You're not going to need that money in a 1 year or 2 years. Yeah, it's for a long horizon, right? So definitely it is going to work out in your favor. In fact, on the other way around, I would say when the market crashes, you should proactively ad hoc investment should be done.
Okay.
Yes. So apart from the SIP, you actually push some more money into the same fund,
Okay. So
so
that
that you get
cover the
more number of your units. Exactly. And that's the reason I always suggest uh, new investors, if you have 100 rupees savings, push around 80 rupees into your investment, into equity or balanced fund, 20 rupees into your money market fund. Okay, so that 20% of that investment that you are putting into the money market fund can be utilized for the market crashes. Whenever market crashes, okay, you go there and you say, okay, now you have got some work to do. So you push all that 20% thing in a sequential manner, as and when the market is crashing.
okay.
So that is going to give you a better return in the long run. Again, this strategy is again trying to trying to time the market, which is not a good thing in my opinion. But it is a better approach, because even if you don't do it, your money market fund is going to give you at least a decent 7 to 8% return. Yeah.
Right. So basically, money market funds
Right.
are kind of liquid funds.
Right. Well, those are liquid funds. It is better than your FD. It is better than, yeah, more or less FD, and definitely better than your savings bank account return for sure. So money market funds are, so if you are for the example sake I'm doing this. If you are going for HDFC balanced fund, you also have some HDFC money market fund associated with that fund. So
Okay.
you choose the same fund from the same fund house, so that switching that fund when the market is crashing is going to be very easy for you.
Okay. Okay.
Yeah,
So basically, when
because it is going to be just switching the fund.
fluctuations, when we that is when we can take the maximum benefit of SIPs. Like you have to let them allow to tide through the fluctuations, market fluctuations.
Exactly. The idea is that how many number of units that you are going to accumulate when you are in this mutual fund game, right? And as and when the market is going up, and those accumulated units will have better return outcome, right? Better return, overall return. So that is the overall. Even if you have lump sum money, say for example, you saved a lot, but you did not invest. Okay. Say for example, you saved around 5 lakhs rupees. Now you say, okay, market is going up now. So speculation is that it is going to touch 50,000 points. Let me invest it in the coming Monday or Tuesday, all the 5 lakhs. Okay, that's also one of the not correct action in my opinion, because what happens if you actually invest all your 5 lakhs, and on Wednesday or Thursday, if it falls 10% to 20% down, then all your 5 lakhs will go down, and immediately you see like your 5 lakhs became around 4 lakhs, and you don't have any money left. So you are only going to watch your money going down, and again the market needs to correct, then it will come to the zero level. So instead, when you have that lump sum money, never ever invest completely in the one go. You put it into chunks, maybe 5 lakhs. Okay, I'll make around 10 chunks, or 5 chunks. Okay. On Monday, Tuesday, I'm going to invest around a lakh of rupees in the same fund, and I'll see how the market is fluctuating. Say, for example, God forbid, on Wednesday it went down by 10%. That's fine. You are not actually, you still have 4 lakhs with you. Okay. You still have 4 lakhs with you. So you still can invest when the market is going down. Okay. So next week it is going another 10% down. You are going to invest it. Okay. So this is one thing. There is a little bit of mind shift you really need to inculcate. You should be really worried when the market is going up. Okay. It's a kind of a contrarian thinking, and you should be really get excited when the market is crashing.
Got it.
Okay. So you see it as an opportunity
Okay.
to invest when the market is crashing. You'll be fine when the market is going up and up. That's fine, but you need to be a little cautious about it. But most of the crowd, how they think, they'll be excited when the market is really going up, because they see the immediate returns. And in fact, they are so excited that they will end up investing all the money that they have when the markets are at a higher level, and they don't have any money left when the market is crashing, and then they will pull out the money, and they will be missing out the opportunity. So always have some money left for you to invest when the markets are crashing, or when the market is going into the bear market. But don't keep it in savings account. Keep it in money market account, or liquid fund account.
This is going to be a really good suggestion for all my subscribers. Basically, my target audience is from, I'm mostly doing sessions so that age group of 25 to 35 can get motivated from all that I'm doing on my channel. So I think this is going to be a really good suggestion for beginners who want to get started with mutual fund investments. So yeah, thank you.
Absolutely.
It was a good suggestion from your end.
Absolutely, no worries. I mean, see, this is some of the mistakes I did in my early investing. I learned these things in a hard way because nowadays I think you can learn from all these things from YouTube or by reading a blog. But always, I always say like the more first get into the game. Okay, that's very very important. Get into a habit of investing, saving and investing. It should go hand in hand. So yeah, sure.
Good one. So, Srini, like, tell me, like, what exactly do you think, like, beginners who want to get started with investments, like, what kind of qualities do you think that they should have, and what can help them grow in their wealth creation journey? Like, what do you think?
Well, actually, the first and foremost fundamental thing is that they should understand the nature of compounding when you are actually starting your journey. You are at you have an unfair advantage when you are starting early on the investing journey because you have the time dimension working for you.
Okay.
Okay, so the earlier you start, the better your returns will be.
Right.
That is first thing. So the first important thing is that they need to really understand how this entire compounding works. Yeah, I mean there are a number of videos about it, but they really need to understand from their core that okay, I have an unfair advantage because I'm actually starting early. So I should actually stick to in a disciplined manner so that you will actually get a good returns over a span of time. So first thing is compounding effect. The second thing is that uh, I would say there is an analogy, right? So when you buy a Maruti car or any car for that matter, you maybe I think Maruti car used to be like 5-6 lakhs, right? Uh, Take that same amount and invest in Maruti shares, and you buy the car and you invest the same 5 lakhs into the Maruti shares. Maybe I'm talking about 5-10 years ago, and after 10 years your car will be around 1.5 lakh because it depreciates. Obviously, the moment you take your car out of showroom, it is 25% gone. You know that, right? And then the 5 lakhs that you invested in Maruti stock at the time when you bought that car would have been maybe around 20 to 25 lakhs after 10 years, and your car is worth actually 1.5 lakh. Okay, so you see the point, right? I mean, the kind of your investment decision can largely determine the outcome. I'm not trying to say that people should be indulging in direct stock investment, but though the direct stock investment is really, really good, provided you know how to pick the uh, right stocks by doing your research. It's a skill in itself, but
But
that
someone can actually start for a couple of years into mutual fund investments, and once they get hands on, they see in and out, later on they can start with stocks. Is it right?
Well, these are two different things, in my opinion. Okay, because you know that mutual fund is going to give a better return than your FD or other available options. That's the reason you are embarking onto mutual funds, and you are actually giving the responsibility of managing your fund to fund manager. So your thought process is taken off. So the stock picking part and the other managing the overall portfolio, everything is outsourced to your fund manager and you are paying him the money. Okay, now when it comes to the direct stock investment, there are two ways to look at it. One is day trading, and you are a trader. Okay, you're a trader, day trading, buy now and sell tomorrow, whatever it is, BTST, whatever they call it, right? So if you are indulging in that day trading, it is a risky thing in my opinion. But if you because you have a day job also, right? You cannot manage that stress of fluctuations of the market and making money on trading. So I always advise when people are going for direct stock advice, direct stock investment, you be an investor.
Hmm.
Like you buy the stock and hold it for some time, and then when you get a return, then you sell it off, right? That is one way. So there you really need to understand the financials of the company, like their balance sheet, P&L statements and cash flow statements, and whether that company has a unfair advantage or not. That is they call it as moat, right? Like in their sector they are the leaders and nobody can actually compete with them. That is the moat. So there are ways to actually evaluate a company
Hmm.
and see if that stock is available at a fair price,
Okay.
then you buy it. That is called value investing in the investing terminology. Okay, there is another way also, growth investing. That's for a different session probably.
I'm soon
You
gonna
know,
take
uh,
time.
uh,
I'm going to do one more session with you exclusively for stock investments. I hope it is okay.
sure. So absolutely. I'm more than happy to cover value investing fundamentals probably. Whatever I know, I'm not trying to claim here that I know everything here. Whatever I understood, I'm going to share it with you. No doubt about it.
Right. So Srini, like, what book suggestions do you have, like, for exclusively for learning finance, for stepping into investments?
Mm, I would say there is one book recently. I'm actually listening. Recently, I was listening to that book called Psychology of Money.
Okay.
Okay, Psychology of Money.
Okay.
You will actually, you can get it on Audibles or on a Kindle.
Okay.
It's a great book actually. It's a great book in my opinion, because it gives you the fundamentals of how you look at your wealth creation, or how you look at the mindset, that behavioral economics or psychology that goes for a successful investor. How should actually they be thinking? So by the way, it's not about your timing the market or your intelligence that is going to determine your overall portfolio returns. A mindset that is going to determine your overall returns. Okay, so it is largely what is going on here, right?
Prediction.
What is that?
So you mean to say that conviction is better than prediction?
Well, yes, definitely. Conviction is better than prediction, but actually, that conviction uh, has to be little backed up with some data.
Okay.
Not Do not blindly follow something. Okay, you should learn from the like Charlie Munger and Warren Buffett,
Right.
and there are good books actually. I can suggest you maybe we can do another session on top 10 books that people can go through, right? So, and we can cover the gist of that book in a small video. That
Got
is for another session probably. So books definitely going to help you. And I found this Psychology of Money very well, very good, and quite informative, because the Audible book is really, really good, because the way he narrated that entire book is really good. But of course, you can always buy it on Kindle and you can read it for yourself.
right.
So yeah, definitely that is one book. And it, it's there is one more book I can suggest, which is um, I think it is it's your life and it's your money. I can actually text you that book. That is also really good. But these books, they don't talk about anything about mutual fund per se.
Right.
They talk about
In general,
general way, that in general, what is the kind of mindset that you need for the to be a successful investor
I mean, all this
rather than anything
basically
else.
talk how to inculcate good money habits or how to deal with money.
Deal with money, exactly. And the earlier you gain these skills, the better, because you will have a strong foundation, um, and you have your fundamentals, or the first principles I always call it, in place, so that you don't have to really worry about anything. So that's the reason I always suggest people to educate themselves by various means.
Right. Thank you, Srini, for all your
So
suggestions. I mean, like all the suggestions which you have shared with us on this session must be really useful to someone who has to begin with investments and stuff. So I thoroughly
I
enjoyed.
hope so. Thank you, and I hope these are my personal opinions. Nothing to preach or anything like that. I just shared my own opinions, so people can actually educate themselves and then go ahead and start investing. There are various nice tools available nowadays, like Kuvera,
Mm.
right, where the direct investment and it's I don't have any affiliation or association with Kuvera. I have my investments
Mm.
parked in via using Kuvera tool, and also we have something called I'm sorry, uh, Coin. There is a platform called Coin by Zerodha
Okay.
where you can do the direct investments.
Okay.
But as I said, financial advisor is going to help you plan your investments in a better way.
Mm.
But if you really want to and if you really want to get into that those platforms, you can do it by yourself as well. So just explore, keep exploring it. And one more suggestion before we bind off is that don't buy uh, don't buy too many mutual funds.
Mm. Okay.
Okay, so some people have a tendency,
Mm.
just like a Swiggy order, right? Okay, let's order this dish, let's order this dish, and then let's see how it happens.
Mm.
It's not a menu that you are ordering.
Mm.
Okay, it is your investment.
Right.
So first determine your philosophy and the goal of your investment,
Mm.
and stick to around two to maybe around 3 to 5 funds. That's the max that you could go for your portfolio, and you keep investing in those no matter what.
Mm.
uh, and then rebalance it after a year or so, and then decide which funds to get out and which funds to
Continue.
which new funds to add to your portfolio.
Okay.
Some I used to have this thing called chasing that high return funds.
Okay.
There is a philosophy, right? Okay, oh, this fund is this pharma fund is giving 38% in the last 1 year, let's go ahead and invest in it. So they will go and they will invest in it. Okay, and there is another finance some fund which is giving 40%. Okay, let's go ahead and invest it. So that is not a very good idea in my opinion, because if you have your all your investments scattered with around all the funds, it is very difficult to manage also.
Right.
And also your returns are not going to be your returns are you can't predict your returns. Sometimes it becomes too clumsy. So
Mm.
make sure your investment philosophy and the overall process is very simple
Mm.
and very much monitored,
Mm.
so that the moment it is simple, it becomes very easy for you to monitor also,
Right.
right? Because if you have only 3 to 5 funds, good funds, some are core funds, 3 core funds and 2 add-on funds is good enough actually
So
for the
basically,
portfolio.
quality matters
So
than quantity.
exactly, quality matters rather than the quantity. Because if you have too many funds, then you invest 5,000 here, 10,000 here, 20,000 here, then you will not, okay, then you will only watch that small pocket to grow up and down. Rather, you actually concentrate the entire thing into 5 to 6 funds, and then it is very easy for you to manage. Very easy for you to manage. So that is another suggestion before we wind up actually.
Really
Yeah.
good suggestion, Srini.
Yeah, no problem, Divya. And I wish you all the best for Be Wise and Money Wise. It's a great name, by the way. Very catchy and very direct. I mean, it truly conveys uh, the the
Motive of my
the
channel.
core message, the core message that you wanted to convey. Very creative name, and I wish you all the good luck, and I wish you all your viewers good luck with their investments. So always stick to those first principles. and make sure you have the right mindset, and you'll be fine. Absolutely.
Thank you. Thank you so much for your time and all your valuable suggestions. I really want to catch up with another session with you soon. Like all your suggestions have made me think about all the misconceptions, all the doubts which I had it in my mind are all cleared right now. So I
I'm
really
glad.
enjoyed this session is something that I
Th-
really enjoyed doing.
Thank you, Divya, and pleasure is mine. And thanks for having me on your channel. And hope these small points they can help the viewers down the line. Okay, I hope so. And I wish you good luck. And we are almost at the fag end of this year, and um, I wish everyone a happy new year and stay safe. Okay, and hope 2021 is going to be a fantastic year
Right.
going forward. Okay,
Thank you.
thank you very much, and wish you all the best.